You may have heard that the IRS created something called required minimum distributions to tax your retirement money. I'm here to tell you some legal ways to keep your tax bill lower and let the IRS grab money from those who don't know the rules. I'm Brad, a certified financial planner, and I'm here to help you create peace around the issue of money. As you approach retirement age, managing the tax implications of required minimum distributions, or RMDs, becomes increasingly important. RMDs from retirement accounts can significantly impact your taxable income and subsequently really increase that tax bill. However, there's proven strategies available to help lower the impact of RMDs on your tax liability. Today, we'll talk about two highly effective strategies using Qualified Longevity Annuity Contracts, or QLACs, and Qualified Charitable Distributions, or QCDs, and how they can be utilized to lower the tax bill while ensuring a more efficient use of your retirement savings. Before diving into these strategies to lower the tax bill, let's briefly understand what an RMD is and why it matters. RMDs are minimum distribution amounts that must be withdrawn annually, typically starting at age 72 or 73 for most retirees, and they come out of your IRAs and your 401ks. The purpose of the RMDs is to make sure that you draw down your retirement savings and you pay taxes on the withdrawn amounts, as these funds have likely enjoyed tax-deferred growth for years. So the IRS is rooting for these accounts to grow larger so that ultimately your tax bill becomes larger in the future. Now let's look at some impacts of this. So RMDs can significantly increase the taxable income, which might push you into higher tax brackets, resulting in a larger tax bill. And if you don't need the entire RMD amount for living expenses, the tax impact of RMDs can be a big concern. So I want to take a pivot and discuss a common topic that I typically work with my clients called the Qualified Longevity Annuity Contract, or QLAC. A QLAC is a specialized annuity that allows you to defer a portion of your RMD from your retirement account to a later age, offering potential tax advantages and helping you to maintain the taxable income a little bit lower. So how do they work? By investing in a QLAC, you can defer a portion of your RMD until a later age, typically up to age 85. This deferral can reduce the immediate tax impact of the RMD, as the distributions from the QLAC are not subjected to RMDs until they begin. The funds allocated to a QLAC are not included in the RMD calculation until the QLAC starts making distributions, potentially lowering taxable income and reducing the associated tax bill during the deferral period. The IRS restricts how much you can contribute to a QLAC up to $135,000, or 25% of your retirement account balance. Once the QLAC starts making payments, it can provide a guaranteed income stream, offering financial security during the later stages of your retirement. So let's talk about some of the benefits. The big one is the tax deferral. By deferring a portion of the RMD into the QLAC, you could potentially reduce that current taxable income, which results in a lower tax bill. The QLACs can provide a form of longevity insurance, ensuring that you have a source of guaranteed income in later stages of retirement, regardless of how long you live. Another common subject I like to discuss with some of my clients is a Qualified Charitable Distribution, or a QCD. A QCD allows you, if you're over the age of 70 and a half, to donate up to $105,000 directly from your IRA to an eligible charitable organization, offering both tax benefits and the opportunity to support meaningful charities. So here's some of the benefits, and the big one is the tax advantage. So anything that's given directly to a charity from the IRA through a QCD is excluded from your taxable income, keeping the tax bill lower. QCDs can be used to satisfy part or all of the RMD. Basically, you give it right to that charity. And the key is you need to make sure that the charity is an eligible charity and does qualify to be able to receive the QCD. And as long as it does, then you're good and you get the tax deduction. By utilizing QCDs, you can support charitable organizations and causes that mean something to you. And you can also manage that tax liability in retirement. So you get to do well by doing good. So it's crucial to consider the following factors when thinking about QCDs. The first one is that limit that I mentioned of $105,000 per year. So you can't give any more than that. The second one is the transfer has to go directly to the charity. It cannot go to your bank account first. If you do that, you totally blow up the QCD. So you want to send it directly to the charity. If you follow those rules, you can help the charity and also lower that tax bill, which is really nice. So I think both QLACs and QCDs offer viable strategies for reducing your tax bill and helping to reduce the impact of those large RMDs later in life. I think both QLACs and QCDs offer viable strategies for reducing the tax impact of required minimum distributions. I think they should be explored if it makes sense for you. I think these strategies can play a pivotal role in optimizing retirement income and also tax efficiency by keeping the tax bill lower. But it's also important to note that QLACs and QCDs are not appropriate for everybody. So make sure that you have a clear understanding of your situation. Make sure you understand the rules, use them to your advantage, and utilize one of these things if it makes sense. By proactively exploring options like QLACs and QCDs, you can take meaningful steps to optimize your tax situation in retirement and make the most of your retirement savings. If this strategy interests you, please use the link below to schedule a call with me and I can coach you on how to do it effectively. You can also keep watching to learn how we can help you to make those retirement dreams come true.